Imagine waking up tomorrow and discovering that while you were asleep, your money made more money. You didn't work an extra shift, you didn't sell anything, you didn't even leave your house. Yet somehow your wealth increased overnight.
For millions of Americans, that's exactly how the stock market works. Every day, trillions of dollars move through Wall Street. Companies become worth billions in just a few years. Ordinary people build retirement accounts worth millions over decades. And some of the world's richest people, including Warren Buffett, made most of their fortunes through one simple idea: owning pieces of great businesses. But here's the surprising part. Most people think the stock market is just gambling, a giant casino where people guess whether prices will go up or down. In reality, that's only a tiny part of the story. The stock market is actually one of the greatest inventions in economic history. It helped build companies like Apple, Microsoft, Amazon, and thousands of others that millions of people use every single day. Without the stock market, many of these companies might never have become global giants. So, what exactly is the stock market? To understand it, imagine you open a small coffee shop. At first, everything is going well. Customers love your coffee and business keeps growing. Soon, you want to open a second location, then a third, and maybe even hundreds across America. There's just one problem. Expansion costs money. You could take out a bank loan, but loans have limits. Banks expect repayments with interest, whether your business succeeds or fails. Instead, imagine offering people the chance to become part owners of your company. You divide your business into thousands or even millions of tiny pieces called shares. Each share represents a small ownership stake. Someone buys one share, someone else buys 100. Another investor buys 10,000. Now your company has raised millions of dollars without borrowing from a bank. That money can be used to hire employees, build new stores, develop new products, or expand into new cities. In return, those investors now own part of your business. If your company grows, their shares usually become more valuable. If your business struggles, those shares can lose value. That's the basic idea behind every publicly traded company in America. When people say they own Apple stock or own shares of Coca-Cola, they literally own a tiny piece of those companies. Not enough to walk into the CEO's office and make decisions, but enough to share in the company's success. This simple system changed the world. Instead of only wealthy families being able to fund giant businesses, millions of ordinary people could invest together. Teachers, firefighters, engineers, college students, and retirees could all become shareholders in some of the biggest companies on Earth with nothing more than a brokerage account. But here's the question most people never ask. Once those shares exist, how do they actually get bought and sold? Who decides what a share is worth? And why can the price of a company change by billions of dollars in a single day, even when nothing about the business itself has changed? The answer lies inside one of the most fascinating financial systems ever created. And that's where the real story begins. Now let's answer the question almost everyone has asked at some point. What actually happens when you press the buy button? It feels almost magical. You open an investing app, type in a company like Apple, Amazon, or Tesla, enter the amount you want to invest, and within seconds, you're officially a shareholder. But behind that single tap is an incredibly complex system, working at lightning speed. Imagine you want to buy one share of Apple. Somewhere else in the country, another investor wants to sell one share of Apple. Your brokerage, whether it's Fidelity, Charles Schwab, Robinhood, or another platform, sends your order to a marketplace where millions of buyers and sellers meet every second. That marketplace is called a stock exchange. Think of it as a giant digital auction where millions of buy and sell orders are placed every second. Powerful computers compare those orders almost instantly. If your buying price matches someone else's selling price, the trade is completed in a fraction of a second. No negotiation, no paperwork, and no phone calls.
just computers matching buyers and sellers faster than the human eye can notice.
Here's something many new investors don't realize. When you buy a stock, you're usually not buying it from the company itself. You're buying it from another investor who has decided to sell. Apple doesn't receive money every time someone purchases Apple stock. Instead, ownership simply moves from one investor to another. It's similar to buying a used car. The car manufacturer doesn't earn money every time the car is resold. The ownership simply changes hands. The stock market works in much the same way.
So, if companies aren't selling shares every day, why do stock prices constantly change? The answer is surprisingly simple: supply and demand. Imagine there's only one ticket left for the Super Bowl, but thousands of people want it. Naturally, the price goes up. Now imagine almost nobody wants that ticket anymore.
The seller keeps lowering the price until someone finally agrees to buy it. Stocks work exactly the same way. If more people want to buy a stock than sell it, the price rises. If more people want to sell than buy, the price falls. There's nothing mysterious about it, just millions of investors making decisions every single day.
But what makes people suddenly want to buy or sell? Sometimes it's great news. A company reports record profits, launches a successful new product, or expands into a new market. Investors become more optimistic, demand increases, and the stock price often rises.
Other times, the opposite happens. Sales disappoint, a product fails, the economy slows down, or investors simply become nervous. More people sell than buy, causing prices to fall. In the short term, emotions often drive the market. Fear, excitement, optimism, and panic can all push prices higher or lower. But over longer periods, something much more powerful takes over: the actual performance of the business. Companies that consistently grow their revenue, increase their profits, and create products people genuinely love have historically been the ones that reward long-term investors the most. Which leads to one final question. If investing can create so much wealth, why do so many people still lose money in the stock market? The answer has far less to do with picking the right stock and far more to do with human psychology. If the stock market has created so many millionaires, why do so many people still lose money? The answer isn't because the market is rigged, and it isn't because investing only works for the wealthy. More often than not, it's because people allow their emotions to make their decisions. Imagine buying a stock only to see it drop 15% a week later. News headlines are screaming that the market is crashing, and social media is filled with predictions of another financial disaster. Many investors panic. They sell everything, hoping to stop the losses. Then, just a few months later, the market begins to recover. Prices climb even higher than before, and the people who sold in fear miss the rebound. Meanwhile, the investors who remained patient often come out ahead. This cycle has repeated itself for decades. The stock market has survived wars, economic recessions, oil crises, political uncertainty. The dot-com crash, the 2008 financial crisis, and the COVID-19 pandemic. Every time, many people believed the market would never recover. And every time, history told a different story. That doesn't mean every company succeeds. Many businesses fail, and some disappear completely. That's why experienced investors rarely put all of their money into a single stock. Instead, many choose index funds. An index fund owns shares in hundreds or even thousands of companies at the same time. If one company struggles, others may continue growing. This simple strategy reduces risk while allowing investors to benefit from the long-term growth of the overall economy. It's one of the main reasons why so many retirement accounts in the United States are built around diversified index funds. But there's another secret that's even more powerful. It's not about finding the next Apple. It's about time. Imagine two friends. Sarah starts investing $300 every month at age 25. James waits until he's 35 to begin,
even though he invests the same amount every month.
Both make smart investments, and both earn the same average return. But because Sarah gave her money an extra 10 years to grow, she could end up with hundreds of thousands of dollars more by retirement. Not because she invested more, but because compound growth had more time to work.
Albert Einstein is often credited with calling compound interest the eighth wonder of the world. Whether or not he actually said those words, the idea remains true. Your money can begin earning returns, and then those returns start earning returns of their own. Over decades, that effect can become extraordinary. Small, consistent investments made over a long period can grow into life-changing wealth, simply because time allows compounding to do its work. So, what is the stock market really? It's not just flashing numbers on a screen. It's not a casino, and it's certainly not a shortcut to getting rich overnight. At its core, the stock market is a system that connects businesses looking to grow
With people willing to invest in their future. Every share represents ownership. Every trade reflects millions of individual decisions. And every long-term investment is a vote of confidence in innovation, productivity, and the future of the economy.
The biggest mistake most people make isn't investing too early. It's waiting too long because they believe they need to know everything before they begin. The truth is, the stock market isn't about predicting what will happen tomorrow.
It's about participating in the long-term growth of great businesses over many years. That's how ordinary people have quietly built extraordinary wealth for generations. If you understand that one idea, you don't just understand how the stock market works, you understand one of the most powerful wealth-building machines ever created. Thanks for watching. If you enjoyed this video and want more simple explanations about money, investing, and how the financial world really works, don't forget to like this video, subscribe to the channel, and turn on notifications so you never miss a new upload. I'll see you in the next one.